Good afternoon, everybody on the East Coast. Excited for this afternoon's presentation, Aligning Professionals. We're going to talk about a lot of important strategic concepts for you and your practice. And hopefully at the end, you're going to come away with some great ideas on how you can utilize a team of professionals, attorneys, CPAs, financial advisors, and the like, just like we have here at the Faithward family of companies to do more for your clients. Faithward, of course, is a national network of boutique legacy planning offices that are designed so that Christian advisors can help their clients do more to impact communities, kin, and kingdom purposes. So as we go forward and we start talking about what we're going to cover today, I want you to imagine what you can do from an impact standpoint by helping others maximize the stewardship of the Lord's resources. And so, as we put together Faithward and this 5 division family of companies, we're oftentimes asked, well, why the multidisciplinary concept? Why the team? And it really comes down to this notion: none of us have a monopoly on good ideas. It's not the advisor, it's not just the attorney, it's not just the CPA, it's not the exit planner or deal broker. It's not the banker, but rather we come back to the wisdom of Solomon. We want to have multiple advisors working together in a collaborative environment so that we can inspire stewards to do more. And that's our why as a family of companies. So working together, it positions us in a way that we can impact both the generosity and the purpose of those that we come into contact with. So as we go forward today, we're going to talk about several things. First, we're going to talk about plan giving. And you saw at the front end, we're talking about this great intergenerational wealth transfer and what that means. And a lot of it is boiled down into being in the plan giving space or gift planning space. We're going to talk about professional cross pollination, how that works. We're going to talk about opportunity recognition, which is hopefully what you're going to get the most out of in today's presentation. And then lastly, we're going to do a couple case study solutions going forward. So from a definitional standpoint, let's start with the basics. What is plan giving or gift planning? And for many people that are out there, especially your clients, they might be thinking about this idea of doing something at death. Okay. But when we look at plan giving, what we're talking about is managing capital, okay, during life so that your client can do more with those blessings that they have been charged to steward. So we're looking at things that are going to allow them to do more for their family, things that can allow them to mitigate taxes, and things that are going to allow them to leave a lasting legacy going forward. The why behind this, of course, is arguably even more impactful. And for those people that you serve, you can see the list of the whys that are here. Lasting legacy, you're going to hear me talk about legacy many times today, giving in circumstances that they might not otherwise think they can do it, and potentially doing more for their family as they go forward are some of the highlights that we have. But for you as a professional, we're talking about a near $100 trillion opportunity. The opportunity is huge. Most people, as you know, are moving towards, getting into the philanthropic or charitable planning realm so that they can get ahead of this because we know that people want to bless abundantly, not only their family, but also those cherished causes they have. So as an advisor, how do we capture these opportunities best? What we have found is that it gets to talking about your client's why. What is their why statement? And for so many of the people that we help, it's about this idea of leaving a lasting legacy. And what we believe as a group of professionals is that everything we do across all the professional divisions, all the professional disciplines, is divided into 2 primary phases of leaving a lasting legacy. The first one is stewardship during life. What are you doing to make sure that you are being the best steward you can? And that encapsulates your giving, your living, all the things you're doing, tax wise, accumulation, getting trusted advice from those folks that are out there, all the products, all the services that help you achieve financial independence. Retirement itself is not a biblical concept, but financial independence so that you can dedicate your time. We have time, talent, and treasure. Dedicate your time and talent to other things you're passionate about certainly is. Second phase is setting things up for optimal distribution. Okay, whether that be death, long-term illness, or giving, while you're living, we want to set things up for optimal distribution. And there are 3 primary challenges that we talk to clients about. The first one is lack of communication. We're not going to spend a lot of time on that today, but lack of communication is the hidden killer. It's keeping things too close to the vest. It's not sharing those time honored traditions. It's not talking about those things that are important to you so that you can be a steward and a guide to generosity for the next generation if the Lord takes you home early. The second one is taxes. We're going to talk a lot about taxes today. And then lastly is long-term illness. Slaying those three dragons are optimal. Slaying those three dragons are really essential to leaving a lasting legacy. How do we get there? Well, there is a myriad of ways to do it. Who remembers the periodic table from chemistry class, right? So this is kind of a semi-periodic table, a lot of different strategies that can be utilized. And one of the things that our financial strategies department does is when we're sitting down with a client and we've got a fact situation that's in place, they'll map and mirror what the current client is doing, and then looking at some strategies and basically color code the different strategies that can be implemented so they can see here's where you were, here's where you're going, and here's why it's going to help you leave that lasting legacy. So next, let's start talking about recognizing opportunity. We're going to talk about some opportunities for business owners, stewards during life, but then we're also going to talk about some estate planning pieces. And my hope is that I'll be able to illustrate how the multidisciplinary team that you can build, as well as the one that we have here at the Faithward family of companies, can come alongside you to help you bring additional credibility to your cases immediately, but then also bring expertise from a design and implementation standpoint that you might not otherwise have. The first one that we run into so often because we have been so blessed economically in the real estate department is asset paralyzation because of appreciation. So how many people here have clients that have seen just the enormous amount of appreciation inside their real estate portfolio and have realized that because of this and because they oftentimes state depreciation, that they are truly paralyzed. They are fine with the idea of just sitting back and maybe collecting a less than fair market rent because if they sell, they're going to get hammered. So they are effectively paralyzed from doing anything that's out there. One of the great tools that we utilize, again, an advisor will see the opportunity in sitting down with a client. The advisor will bring it to our financial strategies team with our CPAs and say, listen, let's do an analysis. Let's look at what a charitable remainder trust could do, whether it's a unit trust or an annuity trust. What can it do to try to mitigate the taxes that are out there and provide these three big benefits? The first one is elimination of the initial tax hit on the sale of the piece, including your depreciation recapture. The second one is the tax deduction that it generates. And then thirdly, we've got this ability to take this highly appreciated stock position or real estate position, let's say, and now create an income stream like a pension. More specifically, in an example here, you can look at kind of a middle of the market type of piece of property or a stock position that's out here. And for advisors, and one of the things that I think is important to remember is that this becomes a great strategy for resetting basis. Highly appreciated, concentrated positions in a portfolio for our advisors that we work with. If they're looking to change a portfolio, perhaps into one of our biblically responsible portfolios, and they've got some bank stock or some affinity stock that's out there, this provides an opportunity to say, listen, we're going to take that stock, we're going to put it into a charitable trust. It's going to create a tax deduction so that we can actually reset basis on some of your highly appreciated other holdings. And now we're going to get income from this on a go forward basis. Most important part of this illustration is the bottom left-hand corner. So you can see here, not only do we eliminate the gain on the sale, but we create a tax deduction. That tax deduction can be used against any other income that's out there, and it really makes it a powerful tool to charitable remainder trust. Of course, the legal division at Avitus now can step in and write that charitable trust, putting in any specifications so that what happens when the Lord takes these folks home after they receive this income is now it's going to go to the ministry or ministries of their choosing. When you have a charitable trust, always advisable to have a schedule on the back for those ministries. Times change, ministries change, affinities change. You want to make sure that if any of these ministries happens to fall away or for some reason is no longer in business, that you can change those things on the fly. And that schedule allows you to do that. What about the person, maybe a business owner that's looking for an even bigger, better tax benefit? Along comes the donor advised fund. Through our Faithful Journey Foundation, which is our 501c3 public charity that we created, we have the ability to come alongside business owners and other folks that are looking for intergenerational impact opportunities, and that's the donor advised fund. The American Endowment Foundation recently launched a study where they approximate approximately $325 billion are now in donor advised funds set to bless various charities. We want more of those monies to bless ministries. So we set up the Faithful Journey Foundation as a way to help stewards do more from a tax planning standpoint, but also, again, setting up a multi-generational giving opportunity. This is a place where you can now set up a successor board of advisors, sit around the table at Thanksgiving or whatever holiday you choose, get everyone around, teach them the stewardship lessons, what made you who you are, why you support these ministries, and then teach them to steward the assets as well. This becomes a great landing place also for someone's IRA assets at death or other places that where you have highly appreciated or highly taxable assets that are going to pass to the next generation. They can pass to the donor advised fund and now expand that giving pool as it goes forward. So donor advised funds, very, very popular. And we're going to talk a little bit about how they work and how they can work for business owners, especially as they're looking at transitioning. And again, multidisciplinary practice. We know we've got to tax it if a business owner is selling something. Let's take a couple looks here at what we can do to mitigate taxes, and the donor advised fund becomes one of the most powerful tools you'll have in your arsenal. So generally how it works, and as I just explained, the cash or the appreciated asset is going to go in. That donor advised fund is then going to be set up as a sub-account of the foundation. The foundation's going to take those instructions from the donor, and then it will go and bless those 501c3 or Section 170 organizations to whatever degree the donor wants to give. So great, powerful tool. What's important to also understand with donor advised funds is that they have a lot more bells and whistles from a standpoint of what they can and cannot do relative to something like a public foundation. As you look at this chart here, one of the big things I want you to notice is the differentiation in the actual tax deduction that you're able to get. So that's the biggest difference. One of the benefits of the public foundation also is that it allows you to give anonymously, whereas if you're giving directly to a charity, it's coming from you, you're giving through your donor advised fund, you can give anonymously if you want to do that. So lots of great benefits, some of the biggest ones being the tax benefits, though, in the donor advised fund itself. Donor advised funds, if you're working with the right foundation, also have the ability to deal with complex assets. This is another one of the reasons why we set up the Faithful Journey Foundation, is because of our affiliation and tie to Avitus Law and our internal CPAs. We felt confident that we can deal with complex assets, whether it's holding LLCs that have real estate in them, whether it's business assets that are there, taking care of the tax returns for the unrelated business income taxation that's out there. We've got the ability to handle all that. So we're never going to turn away an opportunity to impact kingdom purposes through a complex asset and coordinate the valuation to make sure that the donor gets full fair market value for that donation. Let's take an example, look at an example here. So let's say we have a $30 million business. Someone has been very, very successful. They have a tendency to give away about $1 million, or 10% of their income. They earn $1 million. They give away 10% to charity. You can see their lifestyle and investment opportunities there at about $495,000, whereas they've got about $405,000 of tax. This assumes about a total tax rate of about 45% between state and federal. So while they're alive, they decide to give a little bit away. We're going to give a portion of that business, just 1%, tiny, tiny bit in the scheme of things. But by giving $300,000 worth of value, it does two things. The first thing it does is it creates a deduction. Okay, that deduction is going to help offset taxes that they have on that income. And it's going to allow them to have that income on a go-forward basis. That 1% will never be taxed back to them again. Very popular strategy. We have many business owners who have donated a percentage of their company there and said, listen, this is my tithe pool. So I know 10% of my business profits are always going to go in here. And rather than getting them and then trying to donate them and hoping that I'm not above the AGI floors, I'm just going to have a flow directly into the donor advised fund, and then I'm going to give from that on a go-forward basis. Meanwhile, this year, I'm going to get a nice tax deduction that's going to help me offset my income. And you can see the results right there. They end up with more in their pocket, $630,000, and less from a tax standpoint that they have to pay this year. Important notification, important disclosures as we're talking about the donation of complex assets, especially business assets, is you need to understand how the business is organized. C corporations give us really the most flexibility. However, S corporations and partnerships can be donated as well. Biggest thing we need typically have to keep an eye on there is hot assets, things like inventory and things that will be ordinary income taxable as opposed to potentially capital gains taxable. We won't get the same deductions when we put those things in there. And this is an area, again, where our CPA team helps with the advisor and the business owner understand these pieces and really map out a way to do things. Many business owners own a piece of real estate associated with the business. We will utilize different tools. Oftentimes, the real estate ends up being what ends up going in to offset the taxes on the business sale itself. So let's do one more quick look at how this works together. A case study here, business sale itself. So we've got the idea of the business owner who is donating a portion but continuing to work. So now let's set it up for the person who's ready to sell the business. No charitable gift, giving away some of the proceeds, which so many of our business owner clients want to do. And before they come, in contact with us, many times they're saying, listen, my plan is to get it. I'm called to tithe. I'm going to tithe a portion of it, and then I'll see what I can do with the rest. Or, the fully planned version, which is really the donation of interest before things happen. So first, we've got a $20 million sale of a business. Again, assuming that 45% overall tax bracket or tax rate, I should say, you can see what the results are here, about $5 million of tax. Secondarily, someone says, you know what? I want to give a portion here to ministry. So I'm going to go ahead and give $4 million of my proceeds away. And that's going to give me a tax deduction. That's great. $1 million tax savings, that's there. But it certainly reduces what goes to the family at the end of the day. Same gift amount, just done pre-sale, and there are some special rules of that, which we'll talk about in a moment. Now we get an even bigger bang for the buck. And this, again, is the multidisciplinary team. This is working with the attorneys that This is working with the CPAs. This is saying, listen, if you've got somebody who's considering going down the road of selling a business, before they look at the LOI and take it to the next step, before they sign the agreement of sale, we want to get in front of them and we want to talk about strategies. The donor advised fund becomes an awesome one now because they put this $4 million into the donor advised fund ahead of time. No taxes paid on the sale, and you're going to get a tax deduction to offset the rest of what you keep. That $4 million now becomes the proverbial tithe pool. This is what you give from on an ongoing basis, as opposed to trying to figure out where to give $4 million today to one ministry. Awesome, powerful tool, more in the pocket for the family, less to Uncle Sam, and that is what we would call winning from a standpoint of legacy planning. I mentioned some technical considerations here, pre-arranged sales, the LOI, the agreement of sale. You got to do these things ahead of time. The government wants people to have altruism, and the desire to give at the heart, as opposed to, oh man, I got to pay taxes. Now let me come up with a strategy. We don't want to have that. We want to make sure that we are maximizing what we can do across the board. We've got unrelated business income taxation issues we can deal with, voting and non-voting. Presentation for another time, but ideally we want to set up non-voting interest when we're putting in something into a donor advised fund so they don't have control over the entity, especially if the sale is something that's going to happen down the road. So we've talked about strategies while you're live. Let's shift over to that distribution later concept in estate planning. And we tell clients all the time, there are 3 groups that are going to come after your money, both today as well as when you go home to be with the Lord. First one's you and your family. Second is charity and ministry. The third is Uncle Sam and his cronies. You got to pick 2. And that is a hard, fast truth. No matter where you live, you got to pick 2. So how you organize things is very, very important as you go forward. And of course, it's important to understand that ministries, of course, pay no taxes. So when you're putting this together and you're thinking about this, oftentimes we'll say, listen, how many ministries do you have that you want to bless? Talk to me more about those affinity ministries that you have or what you might want to do from a charitable standpoint. Often we hear the adage, I'm doing my giving while I'm living, so I'm knowing where it's going. To that, as an advisor or as another professional, I will come back with this concept, which says the following. Sir, Mr. or Mrs., you will be a philanthropist when you die, whether you like it or not. The question becomes, will you be a voluntary philanthropist or an involuntary philanthropist? And that's what you have to choose. And when we look at what kind of things are going on the involuntary philanthropy standpoint, most people say, all right, I get it. We can do more. Let's talk about making sure that we're controlling where our dollar is going when we die so that we can maximize impact for kingdom purpose. Now, not every asset is taxed the same at death. And one of the great things that our team does for the advisors and other professionals that we serve is we will put together an analysis. We call it the death tax analysis, depending on the state, whether it's an inheritance tax state, an estate tax state, or just someone who's got an IRA in a non-tax state, like let's say Florida. Now we put together this analysis and we color code the exposures. And as you can see here, different assets we color code differently because different assets have different tax exposures. We have three levels of taxation that we deal with. We've got the federal estate tax. The federal estate tax, of course, we've got an exemplary exemption right now at $15 million per person. So not on the radar for everybody. However, it is on the radar for a lot more people than you would think. The other thing we know is that we've had 19 changes to the federal estate tax regime since World War II. So the constants change. You go back to 2000, you had an exemption of just about 500,000 with a 50% tax. Right now it's 15 million, 40% tax. A constant has changed. We want to keep that on the radar. The second layer of taxation is if you live in a state estate or a state inheritance tax state, is you've got those pieces. Pennsylvania has a 4.5% inheritance tax, whether you've got $10,000 or $10 million. So we need to make sure that we're being cognizant of that as well. That would be something that we would deem kind of orange or yellow. You can see on here orange for annuities. Annuities, of course, the basis is only inheritance taxable if you live in a state like that, or non-taxable if you don't have a state death tax. But the growth, of course, is ordinary income tax, just like a pre-tax retirement plan, like an IRA. No matter where you live, no matter where you set up, there's one asset that can pass tax-free, and that's life insurance. Life insurance, of course, can create a leveraged benefit, a new asset class, highly recommendable. And for those professionals who work with, you have an insurance division that actually can help put these things together in second to die or survivorship type of policies that are in place. So let's talk about some strategies. What are the strategies that are becoming popular that are out there to try to minimize taxes at death? And I mentioned before, no matter where you live, you've got taxes on ordinary income vehicles like IRAs and pre-tax retirement accounts. One of the biggest ones that we've seen come into vogue recently is the testamentary, which means at death, testamentary charitable remainder trust. So we went over the charitable remainder trust before. It works very similarly. But what it does here is it springs into being at death. So this can be built into a will. Again, the legal division can help implement this. We are working with a lot of attorneys in a lot of different states where we actually do the lifting here and we send them the documentation and really the language that needs to be built into a will or a living trust to capture this concept. And really what happens is the executor and the trustee get together at death. They look at the beneficiaries, oftentimes the children, and now what they do is they put together a payout schedule that will last their lifetime like a charitable trust. This is a replacement to the stretch IRA, which went away. Right now, we've got a 10-year window to take money out. That's likely going to shrink over time. The stretch IRA, of course, is gone. The testamentary charitable remainder trust now becomes a replacement for that. Give those IRA assets in there. The kids will get income, ordinary income taxable payouts for the rest of their life. If there's any money left at their death, that will go to the ministries if you're choosing. It becomes a great way to get back to a stretch IRA type of regime. Charitable remainder trusts are irrevocable trusts. All right, irrevocable trusts are just one of the most powerful vehicles that you can have from a standpoint of being able to protect assets. So we talked about those three challenges: lack of communication, taxes, long-term illness. Irrev trust can accomplish things on all three fronts. From a standpoint of long-term illness, it allows you to get assets off the table, start that currently 5-year clock ticking on giving assets away. Of course, it's important, as you'll see noted here, that you want to get away from the health, education, maintenance, and support powers that are oftentimes built into trusts. And this is another area where having the legal expertise that can come alongside you to give this recommendation and this credibility to your advice is really, really important and will help really allow your clients to feel at peace and comfort with regard to those recommendations. And these kind of things are these kind of trusts are what we call sole discretionary trusts, in that the trustee has absolute discretion. This is what has kept it out of payback or pay down for Medicaid purposes for those who end up in that type of situation. And it has really won court battles are those two key bullet points right there. From a tax standpoint, you've got the ability to freeze your estate. So whether you have someone who is at or above or approaching that $15 million mark, now is the time when the exemption is high to put these assets aside and get it out of your dominion and control. That's the key legal axiom with regard to what an irrevocable or irrevocable trust does. Is it gets it out of dominion and control, it takes it out of your estate, it makes it a separate entity in the eyes of the law, and now you can have that protection. And if you put assets that are accumulated or will grow in value into a trust like that, all that accumulation happens outside of the estate. So now you get somebody who maybe has $15 million, or maybe between a husband and wife, they've got 30 or they got 40. And you've asked them the question, Mr. Smith, how much is enough? I think I can live on 10. Great. Let's get that 30 into irrevocable trust or trusts. And now let that accumulate outside for the next generation, for ministry impact, for kingdom impact outside, no matter how big it grows, freeing you from that federal estate tax. You live on the 10. Let's talk about some tax strategies on what we can do with that. So the estate freeze technique, very, very big. And then lastly, you've got the communication component and intergenerational stewardship. One of the biggest trends I'm seeing in trust now is building these, what I call dynasty or heritage provisions, putting together assets and not knowing if you're going to be around for 2 or 3 generations down the road for your great grands or your great great grands, but making sure that the money that came from you, that the Lord had you steward, is now going to have similar type of stewardship potential in the next generation. So we'll see trust that will say, listen, for every dollar that you earn, or for every $3 you earn, you can get $1 out of the trust. For every dollar you give the ministry, you can have $1.50 out of the trust. Instituting those values, trying to teach stewardship from being on the grave. One of those last pieces of your legacy is that communication piece. Irrevocable trusts are also a great vehicle for housing that tax-free vehicle of life insurance. So again, whether you're going to build those heritage provisions that are in there, or you're just simply saying, listen, I'm going to live on what I have. I want to make sure I have a fixed amount for my family. And I'm going to live and give and spend and give the ministry, and I want to pay Uncle Sam 0 at death. This becomes a great tool to ensure that you've got some kind of a financial legacy for the next generation, whether it's just the children or maybe a portion for your children's children as well, is putting life insurance inside an irrevocable trust, and then having that payout at death. And then lastly, we go back to the charitable remainder trust. Planned giving, maximizing the stewardship of wealth, leaving a lasting legacy, finding out a way to replace those assets that you go to bless ministry with. We talked about the charitable trust and how at the end of the day, whatever stuff's going to go to ministry, but depending on the amount you put in, oftentimes it produces more income than you need. And so what many people will do is they will put a couple of these strategies together, irrevocable trust, housing, life insurance, using the charitable remainder trust payments to pay the premiums on the life insurance to replace that remainder amount that's going to go to ministry that's not going to go back to the family. All the tax benefits remain the same on the front end. The payments go to fund this life policy. Any extra that's there, of course, is more that can be lived on or given away. So this is what comes to you when you're dealing with a multi-generational team. This is what is on the table. This is the trend that we're seeing the business go into, is this family office feel for the mass affluent, for the high net worth, but not the ultra high net worth, bringing this expertise to the table. And this is where Faithward can come beside you, and we can help train up the professionals in your area, the CPAs, the attorneys, the advisors, the insurance specialists, whatever you aren't, we can bring to the table, and we can help train up those that are in your area to build, again, more of these multidisciplinary, legacy-focused planning teams to help increase kingdom impact, community impact, and kin impact. Thank you very much. Let me see what questions we have.